Chris has been working in the field of foreign direct investment and advising government for over 9 years. Now, he has extensive experience working in global markets include Asia, Europe, North America, South America, Africa, and the Middle East. I take that that's everywhere in the world. Okay. Now, please, Chris. Thank you.
Thank you. First thing I'd like to say is I'm not an academic, so I don't want questions which are too difficult for me. I'm much more on the practitioner side. So a lot of people here know the Financial Times. Whether you know FDI, I'm not sure. So I'll just briefly outline. So FDI Intelligence, we're everything to do with foreign direct investment. We've our magazine, obviously called FDI. We've got databases, FDI Markets, FDI Benchmark. We advise governments around the world how to get investment. We do lead generation, we do events. So typically we're working with governments over the world, as well as a lot of major companies, advising on what markets they need to be looking at. So our leading product, and where I'll be getting the data from, is called FDI Markets. This is a database which tracks every individual company in the world and where they're investing overseas in real time. So you'll all have looked at the UNCTAD report, the World Bank Annual Investment Report. They're all using our data, and we're just doing it in real time, and they get it 1 year later. So I was given the topic of talking about FDI in China, and basically I had to have a think what I would talk about. So I broke it into two ways. One, let's look at the trends. What's been happening? Let's get some data. I know it's late on a Friday afternoon, but you're academic, you must love data. And two, looking at how to actually attract these companies from China. So if you're working in the UK, how do I engage with Chinese companies? So, first question, how important is Chinese FDI? The answer is extremely important, and I got one stat just while I was sitting there. Just the increase in China's GDP each year is roughly the same size as the whole Turkish economy. So that just shows you how important a market this is to be looking at. So again, let's go into some numbers. So I've broken these figures into 3 different charts. So firstly, you get the outward FDI flow. So that's going to include everything, your FDI stock. And that's why it only goes up to 2015. Next, you've got, the colours don't seem to be working great, but you have the greenfield capital expenditure, which is this one. And the third one, you've got mergers and acquisitions. So mergers and acquisitions, this came from a product called Merger Market, so I managed to get some of the data. And this is just showing you how important mergers and acquisitions are. We've heard it from several of the speakers, but what we haven't heard is how greenfield investment's getting more important. As you can see from 2012 to where we are today, this is in terms of $1 billion. Then thought I would break it down, and let's look at the percentage share of the world. Okay, so let's look at if you look at M&A value, you're hitting about 16% of all M&A in the world are Chinese. But yet, if you look at greenfield FDI, it's down at 4%. So it still shows that the shift from acquiring companies and expanding them, moving to greenfield FDI hasn't completely changed. Take a look at the greenfield value. So it's about 14% of the world, but when you look at project numbers, you're still down at 3-4%. So it's tiny. And again, reading on my way home yesterday, I find it quite interesting when you look at the number of deals being relatively low. Like, I didn't know until yesterday that the US has had over 1,400 M&A deals in China since 2005. So there's actually a lot of M&A happening the other way as well. It's just not reported quite as much. From what I read, it's because US companies tend to keep it on the down low, so the price doesn't go up too much. So then, again, everyone likes a ranking to see where you stack up. So looking at what the ranking of China as an outward FDI player is, if you look at the official flows, it's number 3. So I'll be looking at everything, M&A, FDI stock, portfolio investment, and greenfield. If you look at greenfield capital expenditure, it's number 2. So it's a massive player in greenfield capital expenditure. And I believe the last speaker, we talked about the destinations for this greenfield investment. Well, the top 4 are number 1, Germany, number 2, USA, number 3, UK, and number 4, India. That's in terms of number of projects, so where the Chinese companies are setting up. If you're looking in terms of capital, it's completely different. Number 1 is Indonesia, number 2 is USA, number 3 is India, and I just want to note in India, that is with a 1,400% growth in the past 2 years, and number 4 is Russia. So that's where they're investing in terms of the greenfield projects. But when you look at it in terms of as a source market into developed countries, China is also jumping up the rankings to 4th. And it's actually last year, for the first time ever by our stats, it was the number 1 capital investor into the United States. That's the first time, previously it was either Germany or Japan in terms of capital. So what about to the UK? Breaking it down again by the M&A deals versus greenfield projects, you're able to see that greenfield projects are much larger amount in 2015. Year to date, 2016, that goes up until the end of July. That's just showing you where we are. The really important factor if you're a government organisation who's attracting Chinese investment is this fact down the bottom. 97% of Chinese FDI projects and jobs in the UK are new, compared to less than 60% from the US and Japan. So they're all expansion projects. So if you're tasked with getting new projects, China is a key market to focus on. Whether you do that by setting up an office, whether you do that by going to events, we'll move on to that after what we think are the best approaches to it. With this chart, I actually don't think there's much to see on it, but I'll go over it quickly. It's just showing in terms of the $1 million amount. The reason I say that, and I prefer looking at projects, because one huge capex investment can completely deviate the figures. As you can see, it's just going up and down each year. So I always look at projects as if I'm looking over a 5-year trend. If I'm looking just at 1 year, then it's good looking at jobs created and capital expenditure. Then I thought, since 2012, let's see in terms of greenfield and then merger M&A, what sectors are involved in. And if you look at capital, when you're looking at greenfield, you can see China's investing in all of the largest capital-intensive sectors there are. Real estate, energy and mining, industrial and chemicals. These are where the big money is. You know, like software centres, business services, they tend not to bring a lot of money or huge job creation. But as an economic development organisation, investment promotional organisation, it depends what you're targeted with. You know, in the US, all that people care about is job creation. Number of projects don't matter. Whereas in the UK, certain people are tasked with project numbers, and it's not all about the size or the capital. Whereas in developing markets, capital is one of the key factors they're looking for. Hence why we track all 3 of them in what we do. More interesting is when you're looking at it in terms of M&A, it's not, okay, energy is still number 1, industrials is number 1, but it's not hitting that 45% plus. It's down at 25. The reason is, I think a lot of the M&A is also included in buying technology, buying ideas, buying leadership, and getting a foothold in a new market. So you can see on the top left there, technology, 12%. That's extremely high when you look at mergers and acquisitions. So that's my stats. I have plenty more if you need them. Now I thought we would go on. Another thing we do, as I said, we do reports, and we've published one with our partner WavTech on how to attract FDI from China. So they're a consulting company which does lead generation from China, in fact from all of Asia. 2 offices in China, 1 in Hong Kong, 1 in Taiwan, 1 in Singapore, 2 in India, 1 in Korea, all for attracting FDI and engaging with Chinese companies. That's what they'll be doing. So the feedback we got is, before engaging with companies in China, you need to understand their FDI motives. Why are they investing abroad? And we believe that the overseas FDI is being driven by the going out policy, diversifying its international investment through FDI, allowing private enterprises to engage in FDI for R&D. We then have got the need for Chinese enterprises to globalize. So you need to capture market share overseas, access technology, which has been discussed several times, invest in assets offering good yields overseas. And also, more and more, our data is saying Chinese companies are relocating for lower costs. There's a lot of investment in Vietnam in the manufacturing we've been tracking recently. So that's another move. And it shows like a shift up the value chain, moving from lower manufacturing, moving to semi-skilled, moving to services, and China's completely moving up. And then a few other things is due to some Chinese-led international policy initiatives, such as the One Belt, One Road, etc. So there's a lot of reasons why the companies are looking to invest abroad. Next, if you're wanting to target Chinese investment, what sectors are you going to target? Well, agribusiness and food seems to be big at the minute, especially if companies also going to China for this to meet the local demand. Infrastructure, as we just looked at, there's $1 trillion of FDI planned. Again, just reading the stats. Real estate, companies who are searching a return on investment through FDI, and following Brexit, we've already seen that. If you're reading the FT, a lot of property is being bought up in London. Advanced manufacturing, such as telecom, chemicals, energy, and financial services. Those are what we've identified as the leading growth industries. It's then worth understanding the types of FDI, because it's not just greenfield FDI, as we mentioned before. You need to look at M&As, you also need to look at public-private partnerships, joint ventures, strategic partnerships, other ways to enter the market if maybe you do a partnership with a Chinese company in the UK and grow that. So it's not just M&A and greenfield. So if you're a government and you need to have a strategy to incorporate each of these different offerings. So I thought my chart didn't come up. My presentation's disappeared. Yeah, I'll just hold my laptop and do it. So I have 3 minutes. Let's see how many slides I can do in 3 minutes. So what type of company? That's fine. What type of company should you be targeting? We heard about SOEs versus POEs. Interestingly, our most recent data shows that 80% of Chinese FDI into the United States is now by private-owned companies. So it's, if you could see my beautiful chart I've done, this is increased from 32% in 2011. So it's dramatically changing. Okay. So next, I had a chart just looking at how to identify potential investors. So I've got it in terms of least effective ways, effective and most effective. The least effective ways to identify potential investors in China is using media contacts, using Twitter since it's blocked, or just buying a company database and randomly emailing. We have found that when we engage with companies to be the least successful. Midway successful, we have got business and industry associations, which have been mentioned, government agencies, so getting partnerships with them, which is very important. Supply chain and value chain analysis is very important. Looking at trade analysis of Chinese companies with major exports to your country, again, something to look at. But for us, the most effective are referrals from personal networks, are referrals from other investors in the host country, and using the relevant social media, so using WeChat, using the right social media can be effective. How to approach the market. So the least effective, we have got forming partnerships with business and industry associations. So our team there all have 25 years plus experience doing pure FDI work, and this isn't me saying it from them. Also attending trade shows in the market. Apparently there's not a huge feedback on that. And organising FDI events in your own country and expecting Chinese companies to go there, we find it being not effective. Effective, forming partnerships with central government, forming partnerships with local government, which we've heard about already, doing roadshows where you go and meet companies in China. That's much more effective than expecting them to come and meet you. But for us, the most effective is, one, setting up your own office or putting your own people. You've got a twin city. Why not swap staff and have one of your staff set up in the twin city and really build a relationship? I know that's what Invest Essex do extremely well. And two, if you're not doing that, is use a company who is there already, who does that sort of work. But for me, the number one is having your own people on the ground who know your city, your region inside out, and can start engaging with companies on a regular basis, not in a, like, I'll see you this March and then I'll see you in 2 years' time. You really need to build that relationship. And the last slide is, so how do you contact the companies? So in India, in the US, we found LinkedIn is exceptional. In fact, we managed to get Uber to invest in Birmingham by using LinkedIn alone. No meeting with them, no conversation with them, purely by using LinkedIn. Like, the world is changing. LinkedIn is extremely useful. But in China, we found no success. Again, meeting at trade shows, it's really nice. You can shake hands and stuff. But is there really business being done while you do that? To me, it's about getting a card and setting up a meeting, because that meeting is where you'll really get into the opportunities. Mid-effective is having roadshows and going to their offices and getting to know them much better. And for me, the most effective, again, going back to having someone in the market, having one of your people there, or having a consultant who represents you and acts like one of your team, or organise site visits regularly. You know, I work with a region in the US, Loudoun County. Most people haven't heard of Loudoun County, but 75% of the world's internet goes through Loudoun County. Loudoun County is where all of FDI and everything does their internet, because it's just outside Virginia. Just outside DC in Virginia. It's not seen as dangerous for cost of terrorism, which is why they can't be in DC. So this county, I think I read, it is something like 83 data centres. Like, it's unbelievable if you start looking up Loudoun County data centres. So we do work for them, and they go to China twice every year. And all the big software companies know of Loudoun County. And they go and they just keep engaging with the same companies each year. Alibaba wants to make them every single year. So finally they've got to the stage where they think they'll get an investment. And it is about keep showing your face. We always say you can't do a short-term sell. It's not like India. India is a market you can do telesales. You can get a quick FDI project by calling 100 people and explaining your opportunities. But in China, we think you have to really work on a relationship and work longer term to get that. So I think that's just me out of time. Thank you.
Thanks very much indeed, Chris, for the very, very comprehensive picture of the Chinese overseas FDI and the insights on FDI. I can take one question. Is Jeremy, you have a question? No? Yeah, indeed. Yes, indeed. Thank you so much for Thank you. I think now yes, Dylan. Yes, Dylan.
The commercial databases that you're developing is fantastic. I suppose my question was about how confident are you that you're capturing all of the Chinese, say, greenfield investment projects? I mean, China is a huge country. I mean, how confident are you that you can possibly do that? How do you do it? I suppose that's the question.
Great question, and obviously we get questioned every day on our data. Firstly, you don't know what you don't know. I'll say that. We never claim that we track everything. We'll not track anything which has got a non-disclosure agreement, obviously. We will not track like one guy who moves over and works out of his kitchen, which tends to happen quite a lot in FDI. But we've got a team in China who is doing Chinese articles in real time. We're also, if you take a look, I'd rather cite who uses us and how we're portrayed. So if the World Bank publishes us as their official data, the Bureau of Economic Analysis in the US, this year we're the official stats of the US. The UN UNCTAD report uses us, and 300 governments currently around the world are using us. It's the most comprehensive. We're definitely, I would say, of multinational companies, we track about 97, 98%. Of all greenfield FDI, I would say you're talking 75 to 80%, if we're being realistic. There will be things that will never be captured. But what we do, and what a lot of people don't know, on top of capturing from news articles, etc., we set up linkages with the actual government. So if they've been involved in the FDI project, they send us a list of all the projects they know about. So for example, UK Trade and Investment, every quarter send us through an Excel listing every project they know about in the UK, and then they cross-check it against ours. Crazily, we track more than them, but they do projects that maybe we haven't heard of. But long story too, we don't know, we're definitely not capturing everything.
So the way you collect data across countries is varied. So in order to do international comparisons, I mean, how comfortable should you be in those comparisons?
Well, while it's international comparisons, it's still exactly the same. If it's one company leaving one country going to another, that's what we track. So it doesn't matter if our sources are different.
Well, the methodology to collect the data is different in China, say in the US, or the UK. You said you collect it from BT, or whoever. The methodologies must be different.
The methodologies are the same. UKTI supplements what we track. So firstly, how we track it, if we go right back to it, we track roughly about 30,000 sources. And what we're doing is we've got linguists in all languages based in our Belfast office. The only other office we have where we track data is in China, because people used to question a lot, oh, but how are you getting Chinese data? Because not all news sources make it to the UK. So we had to set that up. We set that up 2 years ago, and we found on average, after having an office in China, we are only capturing 1 or 2 more projects per month than we already were. So we sign up to every news feed you can think of in the world. We buy every industry journal. We sign up to every economic development organisation. We have linkages with all the major consultants, major companies. We use the FT in all their offices around the world to capture it. But it's the same methodology where we're doing it. It's just different levels of disclosure, I think, would be more accurate. You know, if you're going to look at somewhere like, say, South Sudan, firstly, there's not much FDI, so it's a terrible example. But the disclosure wouldn't be the same as if you're looking at somewhere like France. Again, I don't know why I use France. France is the worst place we use. In fact, our data coverage is better in China than France. France is extremely difficult to track data. Extremely difficult. But China, again, we can never even do an analysis because no one else does what we do to see are they tracking more than us, or we can't do an analysis to see what we've missed, because if we don't know about it, we don't know about it. So again, I can't tell you my percentage in every country. I can just tell you against competitors what we do.
Thank you very much. I take one more online, Patrick.
You have a question online from Roger Fon, who's asking, is the investment value for each project on FDI markets an estimate or an actual value?
Again, another good question. I would say about 60% are actual values, 40% are estimates. What you can do, though, with the system, you can switch off estimates. We've got a US patent algorithm where we're capturing the job creation and the capital expenditure if it's not announced. Obviously, with all algorithms, I would suggest using it with an air of caution. I would say, don't look at one individual project, because that could be way out. But if you look at a pool of, say, 50 or 20 plus projects, it's going to be much more accurate. So when we show our capital, we only ever show it for markets or for sectors. We never show it for individual projects. But with all our clients, it can easily be switched off. So if you only want actual figures, the problem you've got is if you look at news articles, if someone opens a software development centre creating 2 jobs, they never announce how much they've invested. You know, it could be $100,000, but they'll not announce that. But if someone's opening a manufacturing plant for 500 people, they love to shout about it. They love to bring a minister to cut a ribbon. And that's obviously easy for us to track, but the much smaller projects, like when we expand our Belfast office, so we hired 3 new people, we never announced how much that cost us. So there's no way we'll ever know that sort of data.